I'm Megan Hansen, Director of Alumni Relations. And I'd like to thank you for joining us for our Lunch and Learn webinar series. I know right now all of us are dealing with some uncertain times, and I just want to say a special thank you to the essential workers, healthcare professionals, and first responders. As an alumni community, we're here for one another, and I hope that each of you and your families remain healthy and safe in these upcoming days. A few reminders about the webinar today. We are recording the webinar for posting for folks that couldn't join us today. Also, all the participants are muted. After Kyle speaks, we're going to answer as many questions as possible. We're going to use the Q&A section down below for questions to be posted. So if you have something along the way or at the end, feel free to put it there, and I'm going to read them at the end for him. All the questions are visible to the group, and the section will be monitored by staff. If for some reason during the webinar you're having technical difficulties or have questions, please use the Q&A and we'll assist you from there. So today I have the great pleasure of introducing Kyle Casarino. He's a 2013 graduate from Roger Williams and a former student fund manager at the Center for Advanced Financial Education, better known as CAFE. Kyle is currently Vice President and Charitable Planning Consultant with Fidelity Charitable. He runs the Southern California efforts and partners with professional advisors to help their clients give to their favorite charities with the fullest impact possible. Fidelity Charitable is an independent public charity and the largest sponsor of donor-advised funds in America. Since 1991, Fidelity Charitable has worked with over 200,000 donors and their advisors to grant $35 billion to more than 278,000 nonprofit organizations across the U.S. Kyle brings a wealth of knowledge on charitable giving with us today. We're also happy to be offering continuing education credits to our finance professionals with this webinar today. So thank you for all joining us, and welcome, Kyle.
I appreciate it, Megan. So yeah, as Megan mentioned, I'm really happy to be here today. And just as we kind of go through this process, I'd like to kind of just set the tone, and I'll pull up I'll share my screen here and pull up the slides. But ideally what we talk about today is a few items, and one, mostly related to the background of charitable giving in America, sort of what that looks like, how Americans give. And we'll also plan to touch on items like the CARES Act and things that Roger Williams are working on too, initiatives, campaigns, just to make sure that every alumni on this call gets the most benefits. So I will share my screen here. Great. So quick background about myself and my role is I'm Kyle Casarino. I graduated at Roger Williams in class of 2013. I now live in Southern California and work at Fidelity Charitable. My role really is to engage with financial advisors, accountants, tax attorneys, family offices to help their clients give more efficiently to their favorite charities. And that's not only giving the right asset, which we'll talk about in a little while, but also using the right vehicle to do it with. So just, I think as Megan mentioned, it's really hard for us to ignore what's going on in America right now. And I think that that's something that I feel like we should touch on early on in this presentation is what's going on with COVID-19. There's 3.6 million cases worldwide. A third of those are in the US, and even larger percentage of that is tied in the Northeast and New York. So, I'm sure that most people that are attending this either know somebody, or whether it's a friend, relative, acquaintance, teacher, somebody that has been impacted by this. And, with over 250,000 deaths in the world, it's something that's very serious and has really impacted everyone's day-to-day lives. And, I think one of the biggest things that you have to think about as we go through this process is that Roger Williams has always been about a shared connection. I mean, not only in my time at Roger Williams, but also as an alumni, there's always been a belief that we're stronger when we work together and support each other. So I think now is the best time to do this. I've been so impressed to see how the Roger Williams community, both on campus and throughout the country, is addressing the needs of not only students, but also implementing action plans to meet current needs that are resulting from COVID-19. And I guess my one ask of the attendees during the session is just to think about ways that you can really rise up and make a difference. for Roger Williams students today and in the future. It's so important that we all play a role in this, and as we go through this presentation, you'll see the different areas we'll talk about. So just to give you a little bit of background about the current landscape of philanthropy, what's going on in the world today, and you'll see here that it's about $427 billion that's being given to charity every year. That's mostly done by individuals. You'll see some done by foundations and corporations, even some folks that are including it in their estate plan. But a lot of giving is happening now and today by individuals all across the country. You'll see on the chart at the left, even in 2008, 2009, when the economy was doing bad, charitable giving certainly dropped a little bit, but it's still there. It's really built into the mindset of Americans giving back, and there's not many other countries in the world that reward donors, right, from a tax benefit standpoint. So as we go through the process, you'll see in the next 20 years or so, probably about $6 to $8 trillion will be passed along to charities, whether that's through lifetime giving or estate giving. So just a massive number, and it's very important for folks to realize the huge impact of charitable giving in the U.S. today. So sort of the why and how. So why do people give, right? So the first of which is the positive impact on the lives of others. Of course, you give to the food bank. You want to make sure that the meals are getting out to people that are less fortunate, passing on values to families about finances and helping others. This could be giving to your religious house of worship, making sure that the next generation is super involved. And of course, the tax savings now and in the future. We'll talk through all the different tax benefits of giving, both with appreciated assets and cash. But one of the biggest gaps right now is that about 88% of ultra high net worth households are still using cash or check to fund their giving. That is so inefficient. Why is it inefficient? Because think about what you have to do to even give cash, right? You have to either realize it as income and work towards actually earning that money, or you have to sell an appreciated asset and pay capital gains just to give that cash out to charity. So we'll talk about throughout the presentation about what better assets to give are, what those look like, and the tax benefits associated with them. So we'll talk about a little bit about the assets specifically to fund philanthropy. And, most easiest way to do it is cash, right? You go online to a nonprofit's website. You can use your credit card. You can kind of give right then and there. It's easy to write a check and put it in the mail or put money in the basket as you're at church. But really what I would encourage folks to think about, especially in the market environment we're in today, is giving non-publicly traded or appreciated assets. So these are everything from publicly traded stock to cryptocurrency to interest in private businesses. Those assets generally carry a lower cost basis. And what that means is basically the price of acquisition, right? So let's say I bought Apple stock for $10,000 and now it's worth $20,000. Well, if I were to give that Apple stock to charity, I get a $20,000 deduction, just as if I wrote the charity a $20,000 check. Really no difference there, but the biggest benefit is that the IRS, usually when you sell an asset like that, will look to collect their tax from it as well, which is better known as capital gains tax. What they'll look for is, and depending on your tax bracket, it could be as high as 35%. So you take, that $10,000 of appreciation, you take out $3,500 quickly, all of a sudden now your charities are getting a lot less, right? So it's the idea of, hey, you can give more today and it's going to cost you a lot less to do that. You only had to pay $10,000 to give away 20, right? Get the $20,000 deduction. So it's a lot better if you're giving assets that have appreciation. The market has multiplied by about 3 times since its low in 2008, 2009. Even with the pullback of this year. So it's important to look at your portfolio and say, hey, I know it's easy to give cash, but I know that there are better assets to give. So we talked about this in the beginning, but America and, the IRS and the Senate and all of our government has really encouraged charitable giving by providing tax incentives, right? So people that are giving cash to public charities, and public charities are pretty much what you know to be true. That's your Red Cross, that's the YMCA, that's a food bank, that's Roger Williams. Those are public charities that you can support. And with cash gifts, those cash gifts will be 100% tax deductible, but you can effectively reduce your income every year by up to 60% for those gifts, right? So an easy example is, hey, you make $100,000 a year. If you give $60,000, you can really take a dollar for dollar deduction there, and your new income that you're paying tax on is now down to $40,000. Okay, private foundations, those are family foundations like grant-making vehicles. Some of you may be familiar with them. The deduction limits are less, but they still are 100% tax deductible. The nice part is, though, especially with people giving earlier in the year, is that there is a carry forward for another 5 years. So it's actually 6 years in total. What that means is that if you're giving, let's say, more than that 60% threshold, you can actually carry forward the residuals to future years. So in that exact same example, let's say I still make $100,000 a year and I give away $100,000 throughout the year in cash. Well, in year one, I could take the $60,000 write-off, but in year two, I can take actually another $40,000 off my income only for the gift that you made the prior year. And with long-term appreciated stock, it is a little bit less, right? So you see the 30% to public charities and 20% to private foundations. But the caveat there is that you don't have to pay capital gains, right? So there's that double tax benefit that comes into play. You know, when we talk about, the 5-year rule really does remind me too, especially of something that I was becoming more familiar with, and that's with more loyal donors at charities, right? So one of the biggest, more interesting campaigns that I've seen Roger Williams do recently is this prestigious Hawk Society. And what it does is that it represents an engaged group of alumni donors who have given for 5 consecutive years or more, right? So these recurring gifts can help provide students with education that's transformative, engaging, and more than anything, inclusive. So on top of this forward-thinking approach, members also have a lot of other benefits, right? So things like special access to university events, e-newsletters that are intended to provide updates from campus and beyond, a dedicated section of the Roger Williams website, an assigned rep that can answer questions that you might have, and then a 5, 10, and 25-year donors even get a special anniversary acknowledgement. So, I mean, it's a great program, and those of you that are giving annually should really take advantage of that. So we talked about capital gains tax. Then when you sell an asset, let's say you bought that, we'll use this example for Apple stock, right? So you bought it for $10,000 and it's quickly appreciated, right? So it's gotten to $20,000, let's say in just a couple months. If you sell it before a year actually goes by, you're having to pay ordinary rates. And that's what you pay income rates at. And that's going to be a lot higher than the 15 to 20% that you would pay from a long-term appreciation standpoint. Okay, so in the short term, you could be taxed at a high 20s or low 30% if you're one of the top income earners in the US. But if you hold it for a year or more, that number goes on to 15 or 20% depending on what tax bracket you're in. Of course, the additional 3.8% Medicare surtax that applies in some cases, mostly for your high income earners. But this is, keep in mind right now, this is all federal taxes. This does not include state taxes, which actually add more dollars back to the IRS. Like most people on this call, I'm sure have a better charity that they can give to than Uncle Sam, right? So in this case, most people that are giving appreciated assets are really avoiding a lot of those taxes and thus getting that deduction in that same year. So instead of liquidating stock, instead of liquidating an asset that's highly appreciated, that could be, artwork, that could be a wine collection that you'd sell. Instead of doing that, it might make sense if you are philanthropically inclined to give it directly to charity because of those tax benefits. This is a quick side-by-side comparison. Keep in mind, this does not include state tax, so it is even more substantial about donating securities directly to charity. But this case study and general example applies for an individual that's in the top tax bracket. That's 37%. Right? They own appreciated stock. They're valued at about $50,000. They only bought it for $20,000, right? So they have that unrealized gain of $30,000. And if that will be sold, they'll be subject to that 23.8% tax. Keep in mind, just federal, still not state tax in there. So you'll notice on the left-hand side, donating the cash proceeds. So this is if you sell the stock and then give to charity after the fact. Well, that 23.8% equals a little bit more than $7,100 in taxes that you pay to Uncle Sam. That way, the charity then, that's if you're giving them every dollar after the fact, gets a little bit less than $43,000. That income tax deduction for somebody like that is just under $16,000. But the better example is just to give the securities directly to the charity, right? So in this case, you don't pay capital gains. The charitable donation, the exact amount is $50,000. That's how much the charity has to spend at their disposal. And the income tax deduction is actually $18,500. What that income tax deduction really shows is the reduction of your income in the year, right? So that means that your income is $50,000 less. That means that you have to pay $18,500 less in taxes. Pretty substantial when you look at the side by side. So before we dive into the CARES Act, I know a lot of you are familiar with it, especially with more of the popular items in the CARES Act, like the $1,200 given to everybody that makes $75,000 or less in 2019, and some of the forgivable loans that you can take from your 401k. I mean, those are the more popular ones. But before we go into this, it's important to take a step back and look at what happened in 2017. So Donald Trump signed what's called the Tax Cuts and Jobs Act. And what that did for a lot of taxpayers is it really made it much more difficult to pass what's called the itemization threshold. And what that means is that the standard deduction, maybe some of you have even seen it in your personal returns, it's doubled now. So for single taxpayers, it went from $6,000 to $12,000. For those that are married filing jointly, it went up from $12,000 to $24,000. And part of that legislation actually took away a lot of popular deductions as well. So the three major ones left, what's called SALT, state and local taxes. That's your property tax, but that's capped at $10,000 a year. So what you pay on your house, your car, that's only capped at $10,000, whether you're single or married filing jointly. The other two popular ones are mortgage interest and charitable giving. So for a lot of folks that are older, retirees, or don't have a mortgage, maybe they're renters, they're not able to pass the itemization threshold. So even if you pay the full $10,000 in property tax, you still have to give away $14,000 if you're married filing jointly, just to take the exact same deduction that you would have if you didn't give a dime away. So it's a serious impact, and about 2/3 of the households in America that used to be able to itemize can't do it anymore. So what has to happen is people are forced to be more strategic with their philanthropy, right? So in most cases, and we'll talk about the uses of vehicles and how it can play into this, but on March 27th of this year, the president signed into law the Coronavirus Aid, Relief, and Economic Security, more commonly known as the CARES Act, to help at least combat some of the issues coming from COVID-19. So one of the biggest incentives from a giving standpoint is an above the line deduction for non-itemizers. We talked about how hard it is to itemize. So that's $300 that you can give away to charity in current day and actually still get full tax advantages for it. It has to be in cash, but it does give the donor the ability to still take a deduction for that. There also is an AGI limit increase for individuals that are still giving cash gifts. Okay, so in the past, we talked about it, 60% for those in normal years. But in 2020, it's a lot different. What the CARES Act did was it said, hey, if you're in that example, if you're making $100,000 and you give $100,000 directly to a charity in the form of cash, you actually don't have to pay any tax in 2020 at all. So it's really, I mean, it's a substantial update and not a lot of people know about it. So that applies for individuals, families. It upped to 25% for corporations. That was actually previously at 10%. So it doesn't include donor advised funds or supporting organizations, which we'll get into in a little bit here, but it really does encourage individuals to support charities right now. The real issue, especially in America, is that, you know, we're seeing it on the business front mostly is, reality is a lot of businesses are having to close, right? This is everything from restaurants to retail stores, and they're not able to keep the overhead without realizing any revenue. So the same applies for nonprofits, and they're in the even more of a tough time that they rely on such a competitive environment and they rely on their donors. So this really is intended for folks that have the ability to do it to really maximize their giving. So we'll go through this pretty quickly because I know that we're running somewhat close to time here, but there are really 4 giving vehicles that a lot of our ultra high net worth clients use. And the 2 that you would do with your living are donor advised funds and private foundations, but there are also ways that you can actually make income from a gift that you make. And we'll talk about that in the form of a CRT and CLTs. So what is a donor advised fund? It's actually an account structure that's supported by a public charity that allows a donor to separate the timing of their income tax deduction with when they actually have to give the money out to charity. Now, there's no setup cost to open a donor advised fund. You can do it online in about 5 minutes, and you can give anything from cash to appreciated assets, both publicly traded and non-publicly traded. So you take the deduction actually on the day that you fund the donor advised fund, not when you give out funds from it, right? So you give it because the donor advised fund operates under a public charity. You get the tax benefits as if you gave those 1,000 shares of Apple to the Red Cross, the Salvation Army, even if you haven't made a grant distribution at all. And by the way, in the meantime, all the assets in the donor advised fund are protected in the shelter that allows it to A, grow tax-free, and B, not have you having to pay any type of income tax or capital gain tax on the growth. So it's a good, people that are good candidates for it are your average everyday Americans. And that's really what I work on mostly at Fidelity Charitable, is with donor advised fund clients. And it could be anything from your sort of average everyday American that in our kind of our past discussion, we talked about, oh, it's tougher for people to itemize. Well, this is the way around it. If you're giving away $5,000 or $10,000 to your church and you really can't take advantage of the itemization threshold or the benefits for giving to charity under the current tax code, well, this is the way around it. You could put 3, 4, 5 years worth of giving into a donor advised fund. Take the tax deduction in the year that you make the gift, allows you to actually itemize that year. You take the standard deductions in future years, all the while your charities receive the same dollar level that they always have in the past. Never notice a hiccup. So pretty straightforward, easy. We have donors that have accounts at $5,000. Our average is actually somewhere around $250,000, with the median being closer to about $19,000. So over 60% of our donors, actually their accounts are under $20,000 balance because of what tax reform did. But we also have about 60 donors that have $100 million or more in their account, which some of you may think that's incredible and just immensely generous. But what it is, it comes from a lot of good planning, a lot of realizing, hey, I have a lot of company stock, and maybe the publicly traded company you work with, or you're going through a huge business sale that's maybe $200 or $300 million, and this is the time to do it, and that's the right vehicle to do it with. So a private foundation, what is it? So this is what I would consider, it's very similar from a tax perspective about how a donor advised fund works, in the sense that the donor gets the tax benefits when they fund it, not when they gift out of it. But private foundations are required to give out 5% per year, whereas in the donor advised funds, there usually are typically no minimum requirements that you give out every year. Although some do have, every couple of years that you do have to hit a certain requirement, although it's very low. I would say that private foundations are, at least in my world, I don't really ever see them open with less than $3 to $5 million. And it's $3 to $5 million now, but with the idea that you might want to add to it over time. And what will happen is it's more of like a business, actually. So a lot of families started to organize board meetings with the family. They'll go on retreats together and they'll talk through next generation planning. They'll even have charity events like golf outings, or maybe they want to have an event at their house, like a dinner or a luncheon. And this is really a way to raise money. You can manage your own investments. There's a lot more control with it. You can have your own scholarship fund. I mean, it really does give you full flexibility, as if you almost opened your own charity. So it really, the private foundation route makes sense for your ultra high net worth folks, but probably not for people that are just giving right out to charity and don't want the overhead or the sort of the downfalls of a private foundation, like the annual filing requirements. A charitable remainder trust, and these are becoming more and more popular with the low interest rate environment that we're in today. But what it is that it helps a donor get a partial tax deduction when they fund it, and then actually provides an income stream to them or another income beneficiary for either a set period of time, like 25 years, or their entire lifetime, sometimes whatever happens first. And there's two kinds. So there is a CRUT, which is a unit trust, and those payments are a fixed percentage of the trust value every year. So that's something like 7% gets paid out. That does not change regardless of whether the market appreciates, depreciates, or whether the investments in there do the same. And then there's a CRAP, which is an annuity trust, and those payments are a fixed dollar amount. So that's every year, maybe $20,000, $30,000 gets paid out of the trust, and that goes to those income beneficiaries, and those are taxed at ordinary income rates. But it's a good it's a good vehicle for those who are interested in maybe getting an annuitized payment throughout their lifetime, but are also charitably inclined. So a lot of folks that are on this call that might be in the financial sector understand what an annuity is. And what it does is that it pays out a dollar value, almost like an income stream for years and years down the road. So it's good as you're getting closer to retirement and want that income stream that you can rely on. Folks that are charitably inclined as well will sometimes open a charitable remainder trust to do just that exactly. And what a leech trust is almost the inverse of what a charitable remainder trust does. Instead of giving to the charities after the income stream is over or when the donor passes away, it actually provides an income stream to a charity directly, right? So that's same deal up front. It's the partial tax deduction, but the payment, instead of going to the donor or the income beneficiaries, will actually go out to the charities and provide them with a steady stream of income. Just like if some of you are familiar with how trusts are set up in general, both of these would require an attorney to set it up, need proper funding, a good investment advisor. So sometimes they get expensive, and both of these are very rarely open with anything under than $500,000 or thereabouts. So it's a sophisticated planning tool because it does take assets out of the estate right away, but also gives charities the idea that, hey, you can rely on this gift for several years down the road. So this is just, I know we talked about all of these individually, but this is just a comparison chart, and really more than anything emphasizes the reason why it's probably not the best asset to give with cash, right? You see that last column, the growth potential. Hey, you get your deduction based on the amount that you give out, but if you're using other vehicles, there's ways to protect assets, help them grow tax-free, maybe even give non-cash or non-traditional items to take a deduction for, and have it monetized for your favorite charities. So cash giving, although easy to do, still requires the donor to really, from a tax perspective, it's the least advantageous. So a lot of folks ask me, a lot of donors, especially the ones that are going through really big liquidity events or wanting to sell their business, realizing a lot of stock options, they're saying, well, hey, I need to commit all this money to charity because my financial advisor has told me that this is a smart thing to do, but I've never really given to charity to the extent that I'd like to. Well, these are 3 resources that are all for free. They're on Fidelity Charitable's website if you want an easy way to get to them, but what they all do is help you research charities. So a lot of donors come to me, especially in Southern California, and say, hey, I've never done this before. I like to give to a food bank in Orange County. Okay, great. Well, GuideStar does a great job of rating charities. It can help you pinpoint what specific sector you want to give into, what the charities are rated. They actually provide a pretty good rating system, and you can even take a look at every dollar that's given there, how much of a percentage of that dollar goes to the actual program itself versus the administrative overhead. I know a lot of people, a lot of donors are very sensitive with how much giving they send, and to a charity from their perspective, how much they use for really their overhead and upkeep versus how much they actually put back into the community. So these are resources that look at charities all across the world and can really make giving a lot easier and less complicated. You don't have to be Bill Gates or sophisticated philanthropist to give to charity in an educated way. So I know we went through that fast, and I know we had a limited time, but I do want to pause now and talk through any questions that anybody might have, or happy to dive into any topics in particular more. But what I would say is, before we go into the Q&A section, we talked about this at the beginning, but it's so important right now for you to really stand up and to provide not only your favorite charities and Roger Williams kind of the support they need, because even though the students are back home and they're taking classes online and the overhead doesn't seem to be there, they still need to run the school. They still need to keep up with the professors, with the overhead. I mean, the rent bills and those, they don't stop because of COVID-19. So it's really important that those of you who are listening to this understand the fact that, hey, even though it's tough times for maybe you and your business, it's also tough times for charities across the country. So I'll pause here and see if anybody has any questions, or if you want me to go into any topics in deeper detail, I'm happy to dive in.
Great. Thank you, Kyle. I do have a question here. So, if you are a young professional and charitable giving is something that you aspire to, but right now maybe you have small amounts of cash to give, what's the best strategy on maximizing your impact?
Frozen.
Oh.
Sorry, I think you were frozen there for a little while, Megan. Can you repeat that?
Oh, sorry. If you're a young professional and you're looking to give to charities, but right now, you have a smaller amount as you're starting out. What's the best way to maximize the impact of your gift?
I would say that the first and foremost, and this is when I started, right after college. I mean, I was just an entry-level employee at Fidelity Charitable, and I was sort of faced with the same issue. It's, I want to give back. I don't have the means to give $100,000 today. The biggest thing that you can do right now is to volunteer. I mean, I know that COVID-19 has made it a little bit tougher to do that, but use what you're good at and provide resources like that to charities, whether that's consultations or maybe you work in a particular technology sector and you can help them with their website or something like that. I mean, those are the kind of opportunities right now that you can actually give without having to reach into your own pocket. So I would say that, charities are always going to need volunteers. That's a great way to start it.
Great. And a little earlier you mentioned Roger Williams, which thank you for that. So we always appreciate all of our volunteers. And I know a lot of alums like to help recruit or help with career services or whatever opportunity you are interested in. We always appreciate volunteers. And as well, gifts of any size. I think we're all right now in uncertain times and every gift makes a difference. So I appreciate you mentioning that. Mm-hmm. So I have a few questions here in Q&A. Let me pull up. So the question here says, does the change that President Trump implemented to encourage charitable giving during COVID make this an advantageous time to open a DAF?
Yeah, that's a good question. So DAFs and some supporting organizations are actually excluded from that because, we talked about in the beginning how a DAF works, and that's you separate the timing of your deduction with when you actually have to give the money out. What President Trump is trying to do through this legislation is to get dollars to charities today, right? So in a donor advised fund, those assets can sit there for years and years, grow tax-free, which is great for particular donors. But in this case, the specific legislation under the CARES Act is more encouraging for folks to give to charities right now, specifically with cash donations to make it readily available for them to actually put back into their business and put back into their charity. So there's a lot of strategies, and we can absolutely talk about this offline, where you can use both, because don't forget, you still have deduction limits for a donor advised fund, and you can do on top of that gifting of cash directly to a charity. So you really could do both in certain circumstances, but the legislation is actually encouraging you to give cash right out away.
Great. Another question is, with a DAF, is there a minimum requirement to open one?
Yeah, so you'll notice pretty quickly that across the financial industry, there are a lot of donor advised fund players per se. So Fidelity Charitable, some of you may not know, is actually the biggest charity in the United States of America. So 3 years ago, we passed the United Way in terms of annual contributions coming into our program. And then 2 years ago, we passed the Bill and Melinda Gates Foundation as the largest grant maker. So at bigger organizations like us and Schwab and Vanguard, we actually, all three of us are in the top 10 in terms of biggest charities in the US. Most of the minimums will start at just $5,000, right? And those are suggested minimums mostly because of the annual administrative fee that comes into play. So that's another important thing to look at, because also community foundations and some other smaller organizations that are not affiliated with a financial firm will have administrative fees. So it's important as you're going through the process and looking around at the different options that you have to start one, how much it costs to do it and what the minimums are. Most of them are as low as $5,000, but some of them could get as high as $25,000 or $50,000 to just start a fund.
Great. And I have a mention here. Someone said, that was great. You provided a lot of information. Is there a way that the visuals can be shared with our participants after?
Absolutely. So that's one of the biggest factors. Not only will the replay be available, but I'm happy to email individuals the PowerPoint deck individually or provide additional resources should you have any follow-up questions. So I know that we did go through that very quick today, and we had the limited time and of course the slight issue in the beginning, but I'm happy to provide that information on a one-off or provide it to everybody here just so that you have the PowerPoint deck to reference. And one of the biggest things too is, that's the great part about being an alumni at Roger Williams. Like, people stay so connected, and that's what you should feel with me too. So if you do have questions down the road, whether it's about what we talked about today or just in general, I would suggest that you reach out and feel free. And even if we don't know each other already, I think it's important that we lever each other because we are part of the same network, and that's part of Roger Williams.
Thank you for that. Another question is, so we talked a little bit about COVID and how that's affecting charitable planning and charitable giving. Is there anything you foresee in the next 3, 6 months, a year that will change in the charitable giving world, or are things in sort of a new position?
Yeah, that's a good question. I would say that one of the biggest changes is family philanthropy that I've noticed. It's more and more, I mean, I think I'm definitely a millennial, and a lot of our grandparents really weren't doing a lot of this with their family, with their parents or our great grandparents, right? They weren't talking about who they're giving to, what they're kind of supporting. So that's one of the biggest changes I've noticed, at least in particular, is how individuals want to include their family members. And that's something that's so important, because what ends up happening is, I've seen it firsthand so many times, somebody, a successor to an account or a beneficiary to a charitable account, or just the next generation in general, gets all this money when their parents pass away and have no idea or have never given to charity in the past. So do they follow the parents' footsteps? Do they do their own thing? How do you even find charities that could benefit from it? How do you say no to somebody that's a friend that started their own charity and wants you to give them $50,000? Like, those are the kind of resources that we're trying to get in front of and saying, hey, let's get people educated early on, because it's too late down the road if you're just inheriting an account and have never done it yourself. So I would say that's one of the biggest changes from a family side. And I guess from just an overall planning side, we see a lot of gifting of, we talked a little bit about this in the presentation, but non-publicly traded assets. And that's everything from real estate to private business interests to cryptocurrency. So I would encourage people to say, hey, if you think it's hard to give to charity of a certain asset, it might be in your mind, but it probably isn't in reality. So I would encourage a lot of folks that have different types of assets to look at your portfolio and say, okay, I want to give to charity this year. I want to support this organization. And think about what asset you give. Don't just write a check because it's easy. Give the most highly appreciated asset in your portfolio. That could be Apple stock in your individual account, but that also could be maybe real estate that you're looking to sell in the near future. So I would just think that in terms of non-publicly traded assets, at the end of last year, we passed the $7 billion threshold of non-publicly traded assets that we've accepted and monetized for charitable giving. So that number is out, just enormous. And that's just Fidelity Charitable. Forget about all the other donor advised fund providers and charities that are getting these assets directly as well.
Great. Thank you for that. So those are all the questions we have right now. And so I'd like to thank Kyle for leading this great session today. I know that I've learned a little bit more about charitable planning, which is awesome. And it's always great to welcome back our alums as speakers and to have our alumni join in as participants. We're all in this together, and we're here really to provide resources to you. So we welcome our alums back with open arms. And we just want to mention that if you need anything, feel free to reach out to the alumni office, and also keep an eye out for upcoming webinars and other engagement activities online as we all weather through this crisis. I hope all of you stay healthy and safe, and we'll be in touch soon. Thanks again, Kyle.
Thanks, Megan.
Thanks.